You've probably grumbled about your tax bill before. Maybe you stared at your paycheck, watched a chunk disappear before it ever touched your hands, and thought, where does all this money even go? But here's the thing most people never stop to ask: how did we get here? Because not long ago, taxing your income wasn't just unpopular. In some very real legal and constitutional senses, it was flat out illegal. This is the story of how income tax went from a desperate wartime experiment to a courtroom scandal to the most powerful financial engine in American history, and how along the way, it became something that costs the average American more than they spend on food, clothing, and housing combined. The government that ran without your paycheck. For most of the 1800s, the federal government didn't touch your income, not because politicians were feeling generous, but because they genuinely didn't need to. The government funded itself almost entirely through tariffs, taxes charged on imported goods, and excise taxes on things like alcohol and tobacco. If you bought a bottle of whiskey or imported a piece of fabric from England, you were quietly funding the federal government without ever knowing it. It was a simple system. Some would even call it elegant, but it had a serious flaw. It placed the heaviest burden on ordinary people who bought everyday goods, while the wealthiest Americans, those sitting on enormous fortunes and industrial empires, contributed almost nothing proportional to their wealth. The system wasn't built for fairness, it was built for convenience. That arrangement held for decades, then the Civil War broke everything open. The first income tax, born from desperation. By 1861, the Union was bleeding: soldiers, resources, and money. President Abraham Lincoln's administration stared down the barrel of an impossible financing problem. The war was consuming cash faster than tariffs could generate it, and borrowing could only go so far. Congress needed a solution, and they needed it fast. So in 1861, they did something that had never been done before in American history. They passed the Revenue Act of 1861, creating the very first federal income tax. It was a flat 3% rate on incomes over $800, the equivalent of roughly $28,000 in today's money. If you earned less than that, you paid nothing. If you earned more, the government wanted its cut. A year later, they refined it. The Revenue Act of 1862 introduced a progressive structure. The more you earned, the higher your rate. It also created the Office of the Commissioner of Internal Revenue, the early ancestor of what would eventually become the IRS. Tax collection in those days was nothing like today. There were no computers, no automatic withholding, no centralized database. The government hired assessors who went around essentially asking people how much money they made. As you might imagine, this led to rampant fraud and creative self-reporting. Despite its flaws, the tax worked. It raised hundreds of millions of dollars and helped finance the Union war effort. But from the very beginning, politicians framed it as temporary, a necessary evil for an extraordinary moment in history. And when the war ended, Congress kept that promise. In 1872, the income tax was repealed. Americans exhaled. And for the next 2 decades, life went on without it. The Gilded Age, the backlash, and the courtroom that changed everything. But something was shifting beneath the surface of American society. The Industrial Revolution was minting millionaires at a pace the world had never seen. Steel barons, railroad tycoons, and oil magnates were accumulating fortunes that would be almost incomprehensible today. Meanwhile, ordinary factory workers and farmers were scraping by, still paying tariffs on the goods they needed to survive. By the 1890s, the frustration had boiled over. Populist and progressive movements were rising across the country, demanding that the wealthiest Americans pay their fair share. In 1894, Congress listened. The Wilson-Gorman Tariff Act included a 2% income tax on those earning over $4,000, the equivalent of around $140,000 today. It was deliberately designed to target the rich and take some of the pressure off everyone else. The wealthy did not take this quietly. Almost immediately, a legal challenge emerged. A man named Charles Pollock, a shareholder in Farmers Loan and Trust Company, filed a lawsuit arguing that the income tax was unconstitutional. His argument was technical but devastating. Under the Constitution, direct taxes had to be apportioned among the states according to population. An income tax, he argued, was exactly that kind of direct tax. The case reached the Supreme Court, and in 1895, Pollock v. Farmers Loan and Trust Co., the justices agreed. The income tax was struck down as unconstitutional. The ruling sent shockwaves through the country. To millions of working-class Americans, it looked like a Supreme Court made up of wealthy, elite justices had just handed the rich a get-out-of-taxes-free card. The anger didn't fade, it intensified, and it planted the seed for something much bigger. The amendment that changed the Constitution itself. If the Supreme Court said income tax was unconstitutional, then the answer was obvious, at least to progressives: change the Constitution. That is exactly what they did. In 1909, Congress proposed the 16th Amendment, which would give the federal government explicit, unambiguous authority to levy an income tax without apportionment among the states. It was a direct response to the Pollock decision, a legal sledgehammer designed to remove every constitutional obstacle in its path. Opposition was fierce. Critics argued that handing Washington the power to tax income directly was handing the government a blank check on the financial lives of every American. They weren't entirely wrong, though they probably couldn't have imagined just how right they would eventually be. Public pressure, economic reality, and years of political momentum won out. In 1913, the 16th Amendment was ratified. Almost immediately, Congress passed the Revenue Act of 1913, bringing the income tax back from the dead. The new structure was progressive, ranging from 1% on lower incomes all the way to 7% for the wealthiest Americans. In those early years, it only applied to a tiny fraction of the population, the genuinely rich. Most Americans would never even file a return. That comfortable arrangement didn't last long. World War I and the first taste of real taxation. When the United States entered World War I in 1917, the government's appetite for revenue became insatiable almost overnight. The Revenue Act of 1916 and subsequent wartime legislation didn't just raise tax rates, they detonated them. The top marginal rate went from 7% all the way to 77%. Read that again, 77% on the highest earners. But even more consequentially, the war introduced a mechanism that would permanently change how income tax worked in practice: withholding. For the first time, businesses were required to deduct taxes directly from employee wages before the worker ever saw the money. No more waiting for annual self-reporting. No more trusting citizens to pay up at year-end. The government took its share first and let you keep the rest. This was the moment income tax stopped being something that only affected the wealthy and started becoming something woven into the daily financial reality of ordinary working Americans. By the time the war ended, income tax had overtaken tariffs as the single largest source of federal revenue. The transition was complete. The old system was gone forever. World War II, when it became everyone's problem. If World War I expanded the income tax, World War II universalized it. The Revenue Act of 1942 is arguably the most transformative tax legislation in American history, more than any single Supreme Court case, more than any constitutional amendment. Before the war, income tax was still primarily a burden carried by higher earners. By 1945, it covered nearly every working American. The reason was straightforward and brutal. Fighting a two-front global war was extraordinarily expensive. The government needed revenue at a scale that had never been attempted before, and the only way to generate it was to bring practically every wage earner into the system. To make sure that revenue actually came in, mandatory payroll withholding was formalized and made permanent. That system, the one where your taxes are deducted before your paycheck is printed, before you have any chance to think about it, is still exactly how it works today. It was designed in the 1940s as a wartime emergency measure, and it never left. How temporary became permanent and expensive. After the war, Americans found themselves in a tax system that had been engineered for crisis and never fully unwound. Top marginal rates through the 1950s and into the 1960s exceeded 90% on the highest incomes. The country was building the interstate highway system, funding the Korean War, and expanding social programs, and income tax was paying for all of it. The 1970s brought a different kind of pain. Inflation was raging, and because tax brackets weren't automatically adjusted for inflation, millions of Americans were being pushed into higher tax brackets not because they were earning more in real terms, but simply because prices were rising. The phenomenon, called bracket creep, quietly extracted more and more money from the middle class without Congress ever having to vote for a single tax increase. By the 1980s, the pressure for reform was undeniable. In 1986, President Ronald Reagan signed the Tax Reform Act, the most sweeping overhaul of the federal tax code in decades. It simplified the structure, dramatically lowered the top rates from 50% down to 28%, and eliminated many deductions that had riddled the code for years. It was hailed as a breakthrough moment, and in some ways it was. But the fundamental machinery remained. Income tax, payroll withholding, the IRS, the progressive rate structure, all of it stayed in place. The system that won't go away. Today, the federal income tax generates over $2 trillion in revenue annually. It funds the military, Social Security, Medicare, federal infrastructure, and thousands of other programs. The tax code itself runs to tens of thousands of pages, so complex that a majority of Americans pay professionals just to help them comply with it. Debates over income tax never really end. Some argue for a flat tax, one rate for everyone, no exceptions. Others advocate for the so-called fair tax, which would eliminate income tax entirely and replace it with a national consumption tax. Progressives push for higher rates on the wealthy, arguing that income inequality demands a more aggressive response. Conservatives argue that lower rates drive economic growth that benefits everyone. Neither side has ever fully won that argument, which is probably why the system keeps lurching forward, patched and modified, but never fundamentally replaced. What started as a desperate measure to fund a civil war, repealed, ruled unconstitutional, resurrected by constitutional amendment, massively expanded through 2 world wars, and eventually embedded so deeply into American life that most people can't imagine an alternative, is today the financial backbone of the most powerful government in human history. From illegal to inevitable, from temporary to permanent, from a 3% emergency measure to a multi-trillion-dollar institution. That's the story of the American income tax, and the bill is still coming. What do you think? Is the current income tax system the right way to fund the government, or is it overdue for a complete rethink? Let us know in the comments.